Today we have a case, a very interesting one, especially to discuss a bit further on this concept, FIRE, Financial Independence, Retire Early. She has a portfolio of $1.3 million that was measured in January 2022, and she was actually intending to quit sometime this year. Whether it's quit or go for sabbatical, I think that's still up for discussion. But let me give you some background for this person. She has no kids, she's single, and take note again, she's only at the age of 30. Now you'll be thinking, age 30 with $1.3 million portfolio, how can that be? Now let's not get too fixated on that number also. Maybe there are life situations that are different from us. So some of the usual ones, for example, first, she came from a rich family background. That's possible. Everybody is born differently. So don't feel too disgruntled if your situation is different also. We look for things that are constructive in today's discussion. Or the other situation, she had some inheritance. Again, that's because parents are lost already. So that's another situation. Or the third possible one is she was a superb investor. So for the last 5-10 years, she's been compounding money very aggressively. That's possible, but in my opinion, not likely. Because later there will be some questions she'll be asking on what to do with the investment portfolio. So I would like to rule that third portion out. In my opinion, the most likely situation of how she built up that $1.3 million was through good salary, good income. And quite likely she was a good saver also. So to build up $1.3 million by the age of 30, in our estimates, it's quite easy to guess. 7 to 8 years of work, the average salary should be $250,000 to make the numbers work, correct? She's also shared that there's a lot of stress, a lot of anxiety, and a lot of guilt from work piling up. To me, that reinforces that she's probably in a good corporate career. There are definitely some occupations that pay well. But again, let's not get too fixated on how that income is derived. We focus on what we can take away from today's podcast, from today's discussion, and apply it to our own retirements. Because today we are talking about financial independence, retire early. As you saw from the thumbnail, right now the portfolio is only worth $975,000. To put it into accurate terms, a loss of $325,000 has been incurred already, or that's about 30+%. Now bear in mind again, this drastic drop is just only about half a year. January it was 1.3 million. Now in June it's only 975,000. So the pain is definitely real. Seeing the amount evaporating from net wealth is not something that many of us can stomach so easily. Let's look at some details. She shared that 30% is in pension, 65% is in stocks, and 5% is in crypto. And I guess that's possible. That explains things, because if you look, Luna coin, for example, in the crypto space, has totally lost its value. If she has invested there, that 5% could have been wiped out. If she bought Ethereum coin, for example, that's 80% off the peak already. So that 5% crypto could have lost significant value, but the 65% in stocks, we don't know what exactly has been invested. That's not been shared. Let's take some examples. Facebook has lost more than half of its value already since its peak. What about for Amazon? It's lost 40% of its peak already. So for an investor who has picked stocks, especially in the tech sector, this massive loss in terms of value is pretty real. And I don't know if you are facing the same situation. So when it comes to retirement, as of now, you could be in a few phases. Now, you just started work, you're growing assets aggressively, that's fine. Ups and downs you can tolerate. But if you're moving towards retirement, or if you have hopes of early retirement, then you need to consider this point, which is, what kind of assets do you want to hold with your retirement portfolio? Because again, when you are in retirement, you don't have active income. You need that portfolio to let you sleep well and derive enough passive income for your expenses, to pay off your bills, correct? So what kind of assets? Is 65% equities too aggressive for you? Can you sleep well with it? Different people have different mindset to things. If you are concerned about market volatility, if you don't have too much experience, then 65% equities could be quite scary. Then the other thing when it comes to measuring retirement also is how much dividends can be derived from that portfolio. Because if you have dividends coming up, you could theoretically still survive market ups and downs. You focus on dividend. So that could be another perspective. But I guess that brings on a big learning point, which is before you get to financial independence, retire, FIRE, I'll strongly suggest that you need to go through a bear market first. Because quite clearly, this lady has not gone through any bear markets. She's clearly spooked up by what's happening on the markets. If you want to get to FIRE, I strongly suggest you have investment experience past the bear market, whether it's 2008 or currently what it looks like. If this is indeed a bear market, then if you survive it, moving forward, if you decide to do FIRE, financial independence, retire early, you are much more prepared psychologically. So get to FIRE after a bear market. I think this is a big learning point, something that I didn't think of before looking at this case. Then the second thing also is, she's at the age of 30, right? Which means she barely worked 10 years only. And there's still a lot of life ahead. I don't know if 30 is really too young for FIRE. So leave your thoughts and comments whether you believe 30 is too young to retire, or maybe she just wants to do something different, I don't know. But I do believe that FIRE, if it's 30, it feels a bit extreme because there's still 50 years easily of life moving ahead. Some other questions that she has. She also mentioned that she wanted to cash out 1 to 2 years of expenses from that portfolio. Now, let me pause a bit there. That shows that she has deployed a lot of her cash to the portfolio already, correct? If not, she would need to sell to cash out for her own expenses. If she has kept 1 to 200,000 in cash, that's fine already. Market downturn, just live on that 1 to 200,000. Because as always, markets don't go down forever. Bear markets don't persist forever. There will be sunshine. The only question is whether you have the right patience for it. So looks like she has deployed most of her cash. So coming to this point, let me ask you again. How much cash do you have in your whole investment portfolio? Have you invested everything? If you are, naturally you are a big concern. If you have a lot of cash, you realize your perspective is different. You'll be thinking this is the opportunity. And on the other hand, if you are close to retirement, make sure you have enough cash for your expenses because market downturns happen abruptly, like what we're seeing right now. She's also concerned that if she were to cash out a portion of the portfolio right now for expenses, then it will set her back. That is actually true because if she's selling out at losses right now and market rebounds, then there'll be a big missed opportunity, correct? So I'd like to answer that question very quickly, just in case you are in a similar situation and you like to quit. My answer to that is quit the job, but don't retire fully. I think it's pretty obvious already. Which means, for her case, she's not broke. She has close to $1 million in terms of value in assets. It's high paying, but she hates her job. Then at this phase, really, just quit the job. Look for something that makes you happy. Look for something that pays you enough for your expenses. Like, a barista job. That's why barista FIRE is a concept actually in the FIRE community. Look for a job that pays off some of your bills and you can actually stop your stressful career in the corporate life. So my answer to that again is quit now, but don't retire. Let's move on to subsequent questions that she has. Right now, she's asking, if she were to sell, should she sell those that are in profits, those that are green, or those that are deeply in the red? Should she cut losses on them? To answer the question, it's actually a bad way to sell investments, especially in terms of retirement. Firstly, if you invested in stocks, you need to understand you're buying businesses, which means you only sell when the business fundamentals are deteriorating. For example, airlines. Warren Buffett sold out on airlines. Some may say it's way too early. But because the deterioration of fundamentals happened, it was an unprecedented event that could last for years and drag companies' profitability down. He did not believe that would be the best place for the money. So that is one way whereby you sell. Or you sell when you believe it's a peak cycle. Something I've done for myself. For example, PropNex. I've sold out on PropNex because I believe property cycles are reached. There could be downturns moving forward. Or even for the hourglass, I'm selling off on the hourglass simply because right now luxury watches seems to have peaked in terms of its euphoria as well as its average price for luxury watches. So you want to sell when the valuations are reached or the fundamentals have deteriorated. Then what about for portfolios? In a bear market, quite simply, when you want to sell, don't sell the equities, correct? Because sooner or later they'll rebound. It's just a time thing. Sell the bonds first. Bonds theoretically have less volatility. If you need to cash out those. Way better than equities when you're selling a loss. Or in a bull market when you're in retirement, sell the equities first because valuations are getting rich, correct? And that's where you trim down on your equity exposure. You sell them off at a profit. So that's a very simple explanation to things. If you have stocks, learn to sell them based on fundamentals or cycles. If you have a portfolio, learn to sell either equities or bonds depending on cycle. So with that, hopefully I've answered quite a bit of the questions, especially for anyone that's looking in terms of financial independence retirement. In that case, I have an investment course on my main channel whereby I teach on how I look at companies. I look at price earnings expansion. If you'd like to find out, look for JOSH TAN Academy. I'll leave links below. If you want to get to financial independence, I think investing properly is a must-have skill to do so. And I don't like courses where they charge you a few $1,000s. I'm showing you how I actually pick companies through that simple online course. So check out the links below, which I'll leave in the summary sections. As a big conclusion point, let me share with you what I've thought through looking at this case. When it comes to financial independence, I think we don't see it as permanent retirement. That feels very scary, especially for someone that's young, 30 plus, or even 40. There's still a lot of life ahead. I'd much rather see financial independence as a means or a time to decide what kind of job you want to take. If you are taking a high-paying job and you're feeling miserable, then no need. Don't do that, because life is very short. Look for something that makes you happy, especially when you have earned the right to do so. You have a portfolio that backs it up. You're closer to retirement than many people. And another big learning point is, when it comes to retirement, it's not smooth sailing also. There are going to be markets ups and downs. Learn to live more from the dividends from a portfolio than the capital gains. That way, you have a lot more patience with regards to that. So as always, if you have a case that you'd like to discuss further on this channel, look for my links below. I'll show you how to do a soundbite to me. And as always, if you have benefited, smash the like button. I'll see you in the next future podcast. Take care as always. Goodbye.